You're listening to 15 Minutes of Finance, where in the next 15 minutes, I bet I can get you excited about investing. Let's do it. All right. Happy Wednesday, everybody. We have a special episode here. We have stocks to watch. We're adding some to the list here. We got to talk about them. When it happens, we talk about it. Too exciting not to. Guys, the stock market's at all-time highs. Everybody's making money. And it got me thinking about who my favorite investor is, Peter Lynch. And, everybody and their mother is making money in the stock market right now. Pretty much everything is making money. That's not, I manage people's money. I don't necessarily feel great. It's not hard to do right now. It's not hard to do. And this is not a knock to anybody who's made money. Obviously, making money is the goal. Everybody wants to make money. That's great. But your real value, especially if you're a money manager like we are, where we're investing other people's money, it's not so much making money when the stock market makes money. That's pretty easy to do, right? There's something called active share. An active share is a portfolio manager's, every portfolio should have a benchmark, right? And so we'll just use a growth portfolio and the S&P 500 as a benchmark. S&P's averaged about 10.29. Active share represents how much of the S&P 500 does the advisor portfolio manager's portfolio, how much of the S&P 500 do they hold? So basically what it's saying is how much of the portfolio's return is because of the index. And that is sort of a industry benchmark of, hey, is this advisor actually providing alpha? Are they actually providing return above the benchmark? And most of the time the answer is no, right? Luckily, we've been one of the people who have been able to do that. Now, obviously, this is not personal investment advice. This is just educational for you. And so we're giving you our opinions and our takes on things. But when I think about our portfolios right now, we're doing really well. Yeah, no doubt about it. But everybody is, okay? And I want people to know that it's so easy when things are doing well. It's when things don't go well. It's when the market is down, like in April, right? Everybody thinks the tariffs are going to ruin the country. Everybody pulls their money out. All right. Anytime, let me tell you the sequence of events here. When there is there's multiple indicators about the economy, right? And the stock market is a part of the economy. There are many factors or indicators, as the industry pros like to say. There's leading, there's coincidental, and then there's lagging. And a leading indicator is something that happens before the economy gets news that it's not doing well. A coincidence indicator is one that happens as the economy is not doing well. And lagging is information that happens way down the road. Okay? So the stock market is a leading indicator of the economy. When the tariff news happened, absolutely everything went to crap. Everything. The stock market dropped 18 or 20%. When that happens, it's like when a dam gets a crack and there's a little bit of water coming out. That crack gets bigger and bigger, and eventually there's just no more dam. It's just flowing water, right? And that's what happens with these type of events. And it just got me thinking that we have it so good right now, and we don't even know it. And yeah, we're bullish. We think the market could keep going. Goodness, the market could be at 15,000 by 2030. We don't really know. We're transitioning from a consuming country into a producing country. And I mean, that's going to be, I get excited even thinking about it because you can't even really fathom what that might do for the economy and thus the stock market. But back to the tariff comparison here. So when tariffs happened, the stock market dropped. That's a leading indicator that the economy is going to have tough times ahead. Instead of the right thing, which would be to say, is this true? Let me do a little bit of research. Everybody and their mother takes their money out of the stock market. So now you have two things affecting the stock market. You have the tariff news, okay, which is Obviously going to affect the economy. That's not entirely good. It's definitely not good for the stock market. It drops 10%, 15%. And then people pull their money out, which also lowers prices. And once you lower prices from pulling your money out, now this and that drops the other 5%. Now we're at 20%. What tends to happen at that boiling point, I guess you could say, is the economy actually suffering? Are earnings reports actually, are companies actually making less money? And what tends to happen when there's an event and then sentiment, right? And so we have the event as tariffs, and then we have the sentiment of people being scared about the tariffs, so they pull their money out. What happens after that is usually companies don't make more money. They usually stop because people take out their money and they hold it and they hoard it. And when you hoard money, there's no money flowing. People aren't buying things. Companies don't have good earnings reports. That then consequently drops the market even further. Okay, so there are all these signs that you can watch economically that will give you insight about what's going to happen with the stock market. And so many people want to pick stocks and not pay attention to the economy. So many people want to pick winners and then trade them after they make 10%. Right? There's so many behavioral finance terms that I think associates with retail investors so well. Right? Because they're so emotional. You are so emotional. And I just want to encourage you guys, stop being emotional. I know you've earned this money with your blood, sweat, and tears, and now you're investing it and you don't ever want to see it go down. But that's the whole point. There is no reward without risk. And so you should not invest money that you aren't willing to risk. So what happened during tariffs? All of our clients got a phone call. I walked them through our take. What was our economic outlook? It was very, very simple. The economy, all of this is synthetic. We do not believe this will actually have a bearing on economic output or input. We think that this is temporary and we just want to wait, right? You know how hard it was for everybody to take our advice? Now, luckily, everybody did. But, I mean, man, that was even a tough call for me to have because in my head, I'm like, man, is this right? My gut is telling me, the evidence is telling me, but then all these analysts and all these headlines, they're all telling retail investors, oh, doomsday is coming, another depression, another recession. Those people who are writing these articles will 3 months later have an article that says, time to jump in, time to get in the market. Well, guess what happened? Guess what happened when they wrote, hey, the stock market is going to dump and people take their money out? They put money in. These analysts are not your friend. Now, they do provide value in the sense that I think that they are honest about their valuations. So when a analyst comes up and they say, hey, look, our valuation on NVIDIA is $195. That is provable, right? And by provable, I mean they typically have to have a theory or a method to getting that number, which is referenceable. You can look that up. Okay, but these guys, these analysts that get to hide behind these headlines, there's no accountability. There's no responsibility from them. So I encourage you, understand economic indicators as best as you can. And I'll do my best, over the next couple coming weeks to really get you guys locked in on economic indicators. But it was too much for me today. We're at all-time highs. Everybody's doing well. I'm getting texts from clients saying, hey, we're really happy. Thank you very much. And I'm just thinking like, man, I definitely have some alpha. A lot of our positions that we've picked are proprietary in the sense that I didn't get them from anyone else. It was my opinion, right? It was our analysis. But how would I compare this? Shooting 8 out of 10 free throws is not impressive if everybody shot between 7 and 9 free throws or made between 7 and 9 free throws out of 10, right? You are compared comparatively to your peers and to others. And money is just one of those things where you don't really get that, right? Clients don't talk about their returns with other people because money is one of those privacy things. So yeah, we are doing well. Everybody's happy. And we have more stocks that we're adding to the stocks to watch list today. But it's just that concept of, you need to understand a little bit more about your money, right? And again, that's why people hire us and hire me, because we can do it. And we're trying to break the industry, break the trend in the industry of immorality, of confusion, right? A lot of these people who are managing your money, or who are even telling you, right? The analysts writing these articles, they don't even know. Nothing is for sure in the investment world. Everything is a best guess. And when you come to terms with that, you will be a better investor, because you will learn about waiting. All right. And I wanted to read this quote. It's from Charlie Munger. I know I said Peter Lynch, and I do love me some Peter Lynch, but this quote, I think, by Charlie just nails this perfectly. Waiting helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that. Okay, I didn't get the deferred gratification gene. I have to work very, very hard at it. That is a superpower, to be able to just suffer day after day after day, and then eventually get the reward, eventually get the gratification. That is how you become a super successful investor. Now, look, there's going to be a lot of people who listen to this podcast, and they trade, right? They're technical analysis people. They like to trade momentum and trade off the charts. Best of luck. Okay, as an investor, as a professional, as an institutional investor, I don't like trading like that. Now, I have bands, right? Like if Palantir falls such and such below, I might buy more. Or if it rises such and such above, I might sell to capture profits. But the best thing you can do is make great picks and hold. That's the best thing you can do. It's much harder to do than to say, though. I admit that. Okay, we're going to talk about stocks to watch. I got 3 minutes. We've already talked about UNH. We haven't done that on YouTube yet. Guys, if you are here at the YouTube channel, please subscribe, please share. We've been running podcasts now for 3 years. We're at Spotify. We were audio only, and now we're transitioning to YouTube. I hope you guys are excited for that. We really want to make this as valuable as possible on that platform, and we got to grow. So please, even if you guys are regular listeners, go to Spotify or go to YouTube and follow us. All right. It's 15 minutes of finance. You'll see our faces. Just help us, right? As if you guys have been around for a long time and you've listened to us, you know exactly what's going on. And it might be time to pay the piper here and give us a share and a comment and a follow, please. Okay. So stocks to watch. We added UNH a couple weeks ago. That's obviously been a great pick. And Goldman Sachs is the new pick we're adding. Goldman Sachs, the bank, ticker GS. A couple of reasons we're doing that. Financials, when interest rates drop, there's more money in the flow. It's just that tends to be a benefit of the financial industries. We also really think that the credit/loan, credit card space is going to grow. People are buying things on credit. I don't agree with it. I don't like it. But industry-wide, that is going to be something that increases, and the investment banks behind that are going to benefit. So Goldman Sachs is one. Another reason we like it is they provide just about a 2% dividend. So you're getting growth and you're getting dividend. There's nothing better than that. That's an assist and a bucket all at the same time. Now, if you don't like Goldman Sachs, you don't want individual stocks, any bank ETF will do. I'm pretty confident for the next 4 months, 3-4 months, the retail side of the second half of the year is really going to boost the financial industry. So any bank ETF will do, even fintech, right? So like other fintechs that we like, SoFi, we've had SoFi since $11. Right now it's at 26, I think, 25, 26. Those are our stocks to watch. Now we will have an episode in a couple weeks where I go over every stock we've picked from the year so far, because we're almost to the last quarter, and I enjoy, maybe we'll do that at the end of the year. Soon, in the next couple of months, we will have an episode where we go over every pick we made for this year and what it looks like and how we did, right? Because we own our thoughts, we own our opinions, and we own what we claim, and we're responsible for the good and the bad. All right, guys, that is it for today. As always, invest early, invest often. We'll see you next week.